Have you ever wondered how people turn a few $100s into thousands through investing? Or why the stock market sometimes crashes while at other times it reaches record highs? And what exactly happens when someone says, I bought shares of Apple or Tesla stock is going up? If you've ever been confused by the stock market, don't worry. You're not alone. The truth is, the stock market isn't as complicated as it sounds. Once you understand the basics, it becomes one of the most powerful tools for building long-term wealth. In today's video, we'll explain exactly how the stock market works. From companies issuing shares to investors making money, how prices change every second, and why millions of people around the world invest in it every day. By the end of this video, you'll understand the stock market better than most beginners. So grab your favorite drink, sit back, and let's get started. Chapter 1. What is the stock market? Imagine your favorite coffee shop decides to expand into 10 new cities. To do that, the owner needs millions of dollars. Instead of borrowing all that money from a bank, the owner decides to sell small ownership pieces of the company to the public. These ownership pieces are called shares, and anyone who buys them becomes a shareholder. The place where these shares are bought and sold is called the stock market. In simple words, the stock market is a marketplace where investors buy and sell ownership in companies. Think of it like an online shopping platform. Instead of buying clothes or electronics, people buy small pieces of businesses. When millions of investors trade these ownership pieces every day, that's the stock market in action. Chapter 2. Why do companies sell shares? Starting and growing a business takes money. Sometimes a company wants to build new factories, launch new products, hire more employees, expand internationally, invest in research and technology. Instead of taking large loans with high interest, companies can raise money by selling shares. This process is called an initial public offering or IPO. Before an IPO, the company is privately owned. After the IPO, anyone can become part owner by purchasing shares. This gives companies access to huge amounts of capital, while giving investors the opportunity to share in future growth. Chapter 3. What happens when you buy a stock? Many beginners think buying a stock means they're simply purchasing a number on a screen. That's not true. When you buy one share of a company, you're buying a tiny ownership stake in that business. For example, imagine a company is divided into 1 million shares. If you buy 100 shares, you own a very small percentage of that company. You won't suddenly become the CEO or start making business decisions. But if the company grows, your investment can grow too. If the company earns profits, some businesses even share part of those profits with investors through dividends. Chapter 4. How stock exchanges work. So where are stocks bought and sold? On stock exchanges. These are organized marketplaces that connect buyers and sellers. Some of the world's largest exchanges include New York Stock Exchange, Nasdaq, London Stock Exchange, Tokyo Stock Exchange, National Stock Exchange of India, Bombay Stock Exchange. Years ago, traders stood on busy trading floors shouting buy and sell orders. Today, almost everything happens electronically. Millions of transactions occur every second through powerful computer systems. Chapter 5. The role of stockbrokers. You can't usually buy shares directly from a company. Instead, you use a stockbroker. A broker acts as the middleman between investors and the stock exchange. Modern brokers allow you to invest through websites and mobile apps. Once you place an order, the broker sends it to the exchange. Within seconds, your order is matched with another investor willing to sell. The trade is completed almost instantly. Chapter 6. Why do stock prices change every second? This is one of the biggest questions beginners ask. The answer is surprisingly simple. Stock prices move because of supply and demand. If more people want to buy a stock than sell it, the price rises. If more people want to sell than buy, the price falls. Imagine tickets for a championship football match. If everyone wants a ticket, but very few are available, prices increase. Stocks work exactly the same way. Every second, millions of investors make buying and selling decisions. That constant competition creates changing prices. Chapter 7. What makes investors buy or sell? Many different factors influence stock prices. For example, a company reports excellent profits. A new product becomes a global success. Interest rates change. Inflation rises. The economy slows down. Political events create uncertainty. Wars begin. Natural disasters occur. New technologies emerge. Even investor emotions can move markets. Sometimes prices rise because people are optimistic. Sometimes they fall simply because investors become afraid. That's why the stock market reflects both business performance and human psychology. Chapter 8: Bull markets versus bear markets. You'll often hear these two terms. A bull market is when stock prices rise over a long period. Investors are confident. Businesses grow. The economy usually performs well. People feel optimistic. A bear market is the opposite. Prices fall for an extended period. Investors become cautious. Fear spreads across the market. Think of it this way. A bull attacks by pushing upward. A bear attacks by swiping downward. That's an easy way to remember the difference. Chapter 9: How investors make money. There are two main ways investors earn returns. First, capital gains. Suppose you buy a stock for 50. A few years later, it's worth 100. If you sell it, you've earned a $50 profit. That's called a capital gain. Second, dividends. Some companies regularly share part of their profits with shareholders. These payments are called dividends. For example, even if the stock price stays the same, investors may still earn income from dividend payments. Some investors focus on growth. Others focus on dividend income. Many successful portfolios combine both. Chapter 10: Risks of investing. It's important to remember, stocks don't always go up. Companies can struggle. Profits can decline. Economic recessions happen. Some businesses even fail completely. That's why investing always involves risk. No investment is guaranteed. The key is understanding those risks before investing your money. Chapter 11: Why diversification matters. Imagine putting all your savings into one company. If that company fails, you could lose a large portion of your investment. Now imagine owning shares in 100 different companies. If one performs poorly, others may perform well. This strategy is called diversification. It's one of the most important principles in investing. Diversification helps reduce overall risk while still allowing your portfolio to grow over time. Chapter 12: Long-term investing versus short-term trading. Not everyone participates in the stock market the same way. Some investors buy quality companies and hold them for years or even decades. They benefit from long-term business growth. Others buy and sell frequently, hoping to profit from short-term price movements. This is called trading. While trading can generate profits, it's generally riskier and requires more experience. Many financial experts recommend long-term investing for beginners because it reduces the impact of daily market fluctuations. Chapter 13: The power of compounding. Perhaps the greatest advantage of investing is compound growth. Let's imagine you invest 1,000. If your investment grows by 10% every year and you leave your money invested, your earnings begin generating additional earnings. Over time, this creates exponential growth. Albert Einstein reportedly described compound interest as one of the most powerful forces in finance. Whether or not the quote is authentic, the principle certainly is. The earlier you start investing, the more time compounding has to work. Time is often more valuable than investing large amounts all at once. Chapter 14: Common beginner mistakes. Many new investors make similar mistakes. Buying stocks because everyone else is buying. Selling during market panic. Trying to become rich overnight. Ignoring research. Investing money needed for emergency expenses. Checking stock prices every few minutes. Following social media hype without understanding the business. Successful investing is usually slow, disciplined, and based on patience rather than emotion. Chapter 15: Why the stock market matters. The stock market isn't just about making money. It helps companies grow. It creates jobs. It supports innovation. It funds new technologies. It drives economic development. Without investors, many of today's largest companies might never have expanded into global businesses. Every investment helps businesses raise capital and build the future. So, how does the stock market work? It's actually quite straightforward. Companies raise money by selling shares. Investors buy those shares through stock exchanges using brokers. Prices change because of supply and demand. Investors earn money through capital gains and dividends. While investing involves risk, long-term discipline, diversification, and patience have historically helped many investors build wealth over time. The stock market isn't a casino. It's a marketplace where ownership in real businesses changes hands every day. The more you understand how it works, the more confident you'll become when making investment decisions. If you found this video helpful, give it a thumbs up and share it with someone who's just starting their investing journey. Subscribe to BNR Universe for easy-to-understand videos on finance, investing, business, technology, history, and much more. And tell us in the comments, if you could invest in any company today, which one would you choose? And why? Thanks for watching, and we'll see you in the next video.